Hello, I'm David Chaston with 90 at 9, brought to you by interest.co.nz. This will get everything you need to know in 90 seconds at 9 o'clock, with news we're starting to contemplate where the peak is and what happens after that. First, the latest set of US Fed minutes in their March 15 meeting shows them increasingly concerned about the pandemic emergency, but not fully engaged. Full forceful actions came after this meeting emphasised just how quickly the economic side of the emergency developed. And it developed not because of official policies, but because consumers recoiled at the implications. American policymakers were downplaying the seriousness, but American consumers were acting. The New York Fed tracked sentiment weekly in March and clearly shows consumers led policymakers with their concerns. Lack of preparation is probably why the US economy is being hit so hard. One analyst sees US GDP falling 30% in the second quarter after falling 10% in the first quarter. And for all of 2020, it will be down just 5% because they bravely assume a U-shaped recovery in the second half. Heading into this crisis, American consumers were pulling back on consumer debt. In February, these levels fell $108 billion from January, the largest month-on-month decline in 4 years. It'll be massively lower in March, and April data is published, you can assume. The point is, the crisis came to reinforce consumer pullback decisions. US mortgage applications dropped 18% in 1 week and are down a third compared with a year ago. The severest decreases are in the coronavirus hotspots, of course, but with today's revelation that the infection rates are jumping worryingly into the middle of the country now, this market may drop twice as much yet. World trade will bear the brunt of this recession coming, but it may also be what brings us out of it. Certainly it'll be vital for New Zealand, but it won't be a fast recovery. China is flooding its financial markets with liquidity, like most other countries, but theirs has the best, earliest chance of working, and working in a way that could help New Zealand. Perhaps we saw the first effects of that in yesterday's dairy auction. In New York, equity markets are extending their Tuesday rally with more enthusiasm today. The S&P 500 is up 3.4% so far, although there are no such signals in Europe overnight or from Asia yesterday. What seems to be driving today's rally is the American modelling that deaths will peak sooner than earlier predicted and at a lower level than earlier predicted. No one seems to be concerned that they didn't need to have gotten out of control in the first place, and they're ignoring the new round of rapid spread of the disease into heartland America. US Treasury 10-year yield is up 3 basis points at just on 0.77%. Gold is down today, dropping by $8 to $1,644 an ounce. And US oil prices are a little lower at just on $24 a barrel. The Brent benchmark is just on $32 a barrel. Updated data shows American crude oil and petrol stocks jumping to near record high levels. And the Russians have rejected American overtures for steep output cuts. The Kiwi dollar has strengthened even further against the greenback, up another quarter cent to 60.2 US cents. On the cross rates, we're a little changed at 96.6 Australian cents, and against the euro, we're firmer at 55.4 euro cents. That means the trade-weighted index is now at 66.7, and its highest in a month. I'm David Chaston. That was 90 at 9, brought to you by interest.co.nz.